We are jumping straight into the latest financial saga today, a deep dive into Chipotle Mexican Grill's Q3 2025 results and the massive market shock that followed.
Yeah, that shock was instantaneous, really. A 13% stock plunge in extended trading, which is stunning when you realize they actually met adjusted earnings expectations.
Right.
The core tension here is that for the third time this year, they cut their full-year comparable sales forecast. That signals, deep, persistent trouble with consumer traffic.
Okay.
So we're diving into why the market reacted so strongly, maybe overreacted to meeting the profit goal, and what their high-stakes path forward looks like now.
Okay, let's unpack this financial scorecard then. Q3 ending September 30th, 2025. Total revenue was $3.0 billion. That's a 7.5% lift year over year, but still a slight miss on expectations, right?
A slight miss, yeah. $3.03 billion was expected. But profitability, the adjusted diluted earnings per share, or EPS, that was $0.29. And that met Wall Street's target. So financially, on the surface, the company seems solid.
But the real story isn't just the bottom line, is it? It's in the comparable restaurant sales.
Exactly. They only managed a slight 0.3% increase there. And what's fascinating, or maybe worrying, is how they got there. That tiny growth came entirely from higher pricing.
So people are paying more per visit.
Right, a 1.1% bump in the average check. But that pricing was basically canceled out by the problem we really need to focus on, a 0.8% decline in transactions. Traffic.
Fewer people coming through the door.
Fewer people. And this marks the third straight quarter that traffic has fallen. That's a trend you just can't ignore.
And when traffic falls for 3 straight quarters, well, management has no choice, really. They have to adjust guidance. They've now signaled they anticipate full-year comparable restaurant sales will actually decline in the low single-digit range.
Which is a drastic revision. Remember, back in February, they were promising low to mid single-digit growth. It's a huge swing.
That traffic weakness must be putting a strain on efficiencies, too.
Right.
What about margins?
Yeah, it immediately hits the margins. Restaurant-level operating margin dropped. It went from 25.5% last year down to 24.5%.
Ouch.
And a key factor there is labor costs. They crept up to 25.2% of total revenue. That's an increase of 30 basis points.
So 0.3%. Why?
Well, partly wage inflation, sure. But more importantly, it's because those lower sales volumes, that lower traffic, meant they were spreading fixed costs thinner.
Ah, the operating leverage works both ways.
Exactly. Rent costs the same whether 100 or 1,000 customers walk in, right?
Yeah.
So lower traffic makes every fixed cost like rent or manager salaries hurt your percentage margin more.
And what about food costs? We always hear about avocado prices, but what's the story now?
Well, food, beverage, and packaging costs actually clocked in at 30.0% of revenue. Technically, that was a year-over-year decrease, which sounds good.
But
But they were still dealing with major headwinds. Inflation, especially in beef and chicken, was a big factor. And they specifically called out the impact from newly enacted tariffs. That cost them about 30 basis points in the quarter as well.
so, inflation and tariffs hitting the food line, lower traffic hitting the labor line, it paints a picture.
It does, and it raises the essential question. Who is missing? Why are people coming less often? CEO Scott Boatwright explicitly referenced persistent macroeconomic pressures.
Okay, so the economy. He detailed exactly who was pulling back.
He did. He noted that the slowdown finally hit their restaurants this year. They'd actually been outperforming the broader industry through 2024, but that changed.
So who is it?
The critical group pulling back seems to be the middle-income household, specifically guests with household income below $100,000.
That's a huge chunk of their customer base, isn't it?
Management estimates it's roughly 40% of their total sales, and they're simply reducing frequency, dining out less often.
Why? Worried about inflation, the economy?
Both. Deeply concerned is how management put it. They're trading down, maybe choosing cheaper options like grocery stores, cooking more at home.
And is there a particular age group feeling it most?
Yes, the 25 to 35-year-old group was called out as particularly challenged.
That's usually Chipotle's sweet spot, right? Younger millennials, older Gen Z.
Exactly. They over-index to this cohort historically. Management cited, significant headwinds hitting this group specifically. Things like higher unemployment, the restart of student loan repayments, putting pressure on budgets, and just slower real wage growth.
So when this specific group feels the pinch, Chipotle feels it disproportionately.
That seems to be the case, which makes their value proposition discussion really interesting.
Right, because management feels the value is strong. They keep saying the price point is around $10 per entree.
Yeah, and their pricing is currently only running about 2% above last year's level. The rest of the industry is closer to 4% on average. So they are trying to hold the line, relatively speaking.
But the consumer perception might be different. The CEO mentioned they're mistakenly being lumped in with other fast casual places where prices are closer to $15.
Hmm. Is that just semantics, though? I mean, the CEO also said, we're not losing that customer. They're just coming less often.
If your core customer is reducing frequency, that sounds like a retention problem to me. You are losing visits.
It definitely sounds like maybe a communication failure or perhaps what you could call a hidden price problem.
What do you mean?
Well, the entree might start around $10, but nobody just gets rice and beans, right?
Yeah.
You add guac, maybe queso, a drink, sometimes double protein.
Suddenly that $10 bowl is $15, $16 easy.
Exactly. And that final ticket price puts them squarely in competition with those fast casual rivals charging $15 average checks. The consumer sees the final number on the receipt, not the base price. And when they're stressed about, say, a student loan payment, they trade down or out.
Okay, that makes sense. So given that transaction debt, that challenging economic reality for their core customer,
Yeah.
how is the company responding? They talked about accelerating their consumer flywheel strategies, operations, digital, marketing.
Right. They seem to be betting heavily on generating new news to drive excitement and visits. Let's start with the menu innovation piece. They saw clear success, they said, with limited-time sauces recently, like adobo ranch and red chimichurri. Apparently, those drove measurable incremental transactions.
Incremental meaning people came specifically for the sauce.
Seems like it. The red chimichurri, for instance, achieved what they called a low double-digit incident rate. So maybe 10–12% of customers ordered it. And interestingly, it even helped accelerate trial of the higher-priced carne asada. People trying the sauce wanted to pair it with the steak.
And they have research backing this up, right? Something about Gen Z and sauces.
Yeah, this was pretty striking. They found that over 90% of Gen Z consumers say they would visit a restaurant just for a new sauce.
Wow,
Yeah.
90%, just for a sauce.
It's a relatively low-cost way to generate buzz and visits, apparently. High excitement driver.
So what's the plan for 2026 then? More sauces?
More everything, it sounds like.
Yeah.
The plan is to accelerate new product news aggressively. They're targeting 3 to 4 limited-time protein offers next year.
That's way up from their usual, isn't it? They normally do like 2 a year.
Exactly. A significant increase from their historical cadence of only 2 per year. Plus, yeah, new sauces, new dips. They are trying really hard to give those lapsed customers, those frequency-reduced customers, a solid reason to come back more often.
Okay, so menu news is one lever. What about fixing the actual experience? Operational execution. Let's talk about that heat equipment package. High-efficiency equipment. It's in 75 restaurants now.
Yeah, the heat package. It's designed to improve both speed and food quality, which is obviously crucial, especially for digital orders.
What's in it?
It includes things like a dual-sided plancha grill, a new 3-pan rice cooker, a high-capacity fryer. The feedback from the restaurants that have it is apparently excellent. They're seeing better culinary execution, better food quality, and real labor efficiency gains.
How much faster, say, is the grill?
Get this. The new plancha cooks meat in less than half the time compared to the old equipment.
Wow, that's significant for throughput.
Huge. And they anticipate rolling this out nationally over the next 3 years, so a big investment there.
Now, sticking with operations but moving to digital. They admitted something interesting, didn't they? A bit of an operational fumble.
They did, yeah. They saw that digital order accuracy had actually declined.
Oh.
And it happened after they adjusted previous incentive plans to focus solely on speed, just the on-time metrics.
The classic get it fast but get it wrong trade-off. We've all been there, right? Open the bag, missing guac, wrong protein.
Exactly. It's frustrating for the customer. And they realized it. It's a painful, maybe, but necessary admission. Sacrificing accuracy for speed damages the guest experience. It likely contributes to lower frequency if people get messed up orders.
So what's the fix?
Accuracy, they recognized, has to be the primary priority now for improving that digital experience. So they are completely redesigning their system-wide bonus targets to reflect that shift away from pure speed metrics. Accuracy first.
Good. That seems critical. But they also mentioned trying to get into new occasions, right? Like catering.
Yeah, trying to expand when and why you use Chipotle. They have early pilots of a catering program running in Chicago. The goal there is ambitious.
How ambitious.
They believe they can grow catering from its current, 1–2% of sales up to eventually 5–10%.
Yeah.
That would be a significant boost.
And something about smaller groups, too.
Right. They rolled out the Build Your Own Chipotle experience
Mm-hmm.
that's aimed at smaller groups, maybe 4 to 6 people. The idea is to expand transactions for groups without just cannibalizing existing sales. They want it to be new money, new visits, not just shifting orders from the main burrito line.
Okay, lots of initiatives, menu, equipment, accuracy, new occasions. Now, let's pivot to the forward guidance for 2026, because this seems like where the really big bet is visible.
Absolutely. This is crucial. The key challenge is immediate. That 2% of price increase they currently have running, it's set to roll off in early December.
Meaning prices effectively go down relative to where they were.
Well, the year-over-year comparison gets tougher. It creates an immediate revenue headwind right as we enter 2026. And at the same time, inflation is accelerating again.
Oh, really? How bad?
Expected to be in the mid-single-digit range throughout 2026. Driven mostly, they said, by those tariffs we mentioned and rising beef costs.
So costs are going up significantly, but the current price bump is disappearing. That sounds like a margin squeeze waiting to happen.
Exactly. And this is the core of their strategic choice, their investment, if you will, in the consumer. Management stated explicitly they do not plan to fully offset this incremental inflation with price increases in the near term.
Wow, so they're going to let margins take a hit.
Temporarily, yes. They said they are prioritizing maintaining that extraordinary value proposition for the consumer. And they admit, point blank, that this will temporarily pressure margins. They are deliberately choosing to focus on consumer frequency, on value perception, over maximizing profitability in 2026.
That sounds great for customers, reinforcing value. But are investors going to tolerate mid-single-digit inflation just eating into margins for a whole year? I mean, that feels like a huge gamble. What gives them the conviction to make that kind of bet?
It really seems to tie into their audacious long-term vision. They sound extremely confident in the long game, even while accepting this short-term pain.
How so?
We'll look at unit expansion. Despite the macro uncertainty, despite the falling traffic right now, they are accelerating new restaurant openings.
Accelerating, even now.
Yep. In 2025, they expect 315 to 345 new company-owned openings. But for 2026, they are stepping that up dramatically. 350 to 370 new restaurant openings planned.
Wait, traffic is declining, margins are under pressure, and they're dramatically accelerating new store openings to potentially 370 next year. That feels counterintuitive, like stepping on the gas with the emergency brake partially on. Where does that conviction come from?
It seems to come from the fundamental unit economics, which are still strong, and the global opportunity they see. They sound confident that these macroeconomic pressures are temporary, and the operational fixes they're making are structural improvements.
So they're building for the day those customers come back, essentially.
Pretty much. And this expansion includes significant international growth, too. They're planning 10 to 15 partner-operated outlets across the Middle East, South Korea, Singapore, Mexico.
Partner-operated, okay.
And 1 or 2 more company-owned spots in Europe. They even noted, interestingly, that opening volumes in places like Kuwait are rivaling the best new openings they see in the U.S. and Canada. So the brand travels.
So if you connect this all back to the bigger picture, they aren't backing off their long-term goals at all, are they? That 7,000 North American locations target, surpassing $4 million in average unit volumes.
Not at all. They seem to be accepting this near-term financial pain, this margin pressure, as the necessary cost of securing that long-term dominance and hitting those huge goals.
So summarizing here, we've got a brand with really strong long-term ambitions, good unit economics fundamentally, but facing acute short-term pressure. An economically stressed core customer, particularly that younger, under $100 K income group, just isn't visiting as often.
Right. And the company is actively betting, making a very deliberate choice, that by holding the line on price for now, by innovating the menu constantly, and by fixing their digital execution, especially accuracy, they can win back that frequency faster than their competitors, even if it hurts profits in 2026.
It's a high-stakes strategy. So given this intentional trade-off, really, sacrificing margins next year to boost consumer value, here's something for you to think about. What new metric, maybe something beyond just simple comparable sales, will be the most telling sign that these operational and digital fixes are actually working, that they're successfully regaining transaction frequency among those crucial lower and middle income guests they need back?